On January 13, 2026, the eerie silence in the American banking sector was officially broken forever. Regulators from the Illinois Department of Financial and Professional Regulation walked into a quiet Chicago bank branch that afternoon. They declared Metropolitan Capital Bank and Trust insolvent and seized its assets immediately before the close of business. This sudden event marks the first federally insured bank failure of the new year, 2026. For months, financial markets had been lulled into a false and dangerous sense of security and stability. We were told repeatedly that the banking crisis of previous years was contained and effectively over for good. But the closure of Metropolitan Capital proves that the distress in the system is still alive and growing. It signals that the long-touted lag effect of high interest rates is finally arriving with brutal force. If you want to protect your wealth during this banking shakeout, you need to subscribe to the channel now. Hit the notification bell so you get the alert the moment the next bank falls in your state. We are the only channel tracking these regulatory actions in real time for your safety and financial security. Leave a comment below telling us where you're watching from and if you trust your local bank. I read every single comment to gauge the real sentiment on Main Street USA today regarding this crisis. And please make sure to subscribe my collaborator channel, Finance Unfold. Kindly support to reach 1K subscribers. Now coming back to topic. The failure of Metropolitan Capital Bank and Trust is a small but critical warning signal for every depositor. The bank held approximately $261 million in total assets at the time of closing. It was not a massive systemic institution like the failures we saw in 2023 like Silicon Valley, but its collapse tells us that the pressure on smaller community banks is becoming unbearable in this economy. The Federal Deposit Insurance Corporation was immediately appointed as the receiver for the failed institution to manage assets. They entered into a purchase and assumption agreement with First Independence Bank of Detroit, Michigan to protect depositors. This means that the deposits of Metropolitan have been transferred to a new owner overnight without any interruption. The branches of the failed bank reopened on Monday as branches of First Independence Bank for normal business. For the depositors, this means their money is safe and insured by the federal government up to limits. But for the shareholders and the unsecured creditors of the bank, the money is gone and equity wiped. The equity of the bank has been wiped out completely by the regulatory seizure action taken on Friday. The official press release from the FDIC cites unsafe and unsound conditions as the primary cause of failure. They also noted an impaired capital position that left the bank unable to operate safely or lend money. This vague language usually covers a multitude of sins, including bad loans and poor management decisions over years. But in this economic environment, it points directly to the stress of higher for longer rates crushing margins. Metropolitan Capital was a commercial bank that served small to medium-sized businesses in the Illinois market area. These are exactly the types of borrowers that are struggling most with the current economy and inflation pressures. When business borrowers cannot pay their loans, the bank takes the hit to its capital reserves directly today. And when that capital falls below a certain regulatory level, the state regulators have no choice but act. This failure follows a quiet period where no banks failed in the second half of 2025. The last bank to fail before this was Santa Ana National Bank in June 2025 in Texas. The failure was also small, but it was driven by similar underlying financial pressures and asset quality issues. And before that, we saw the failure of Pulaski Savings Bank in January 2025 in Philadelphia. It is an eerie coincidence that both years started with a regional bank failure in the first month. Pulaski Savings failed on January 17, 2025, exactly 1 year prior to this new failure window. Now Metropolitan Capital has failed in the same month and in the same region, effectively signaling a trend. This suggests that there is a localized pocket of distress in the Illinois banking market that is spreading. But it would be a mistake to dismiss this as just a local Chicago problem in isolation today. The pressures facing Metropolitan Capital are being felt by thousands of banks across the country right now. Every bank that holds commercial loans and real estate debt is fighting the same battle for survival daily. They are holding older loans that pay low interest while paying depositors high interest rates to keep them. This squeezes their profit margins and slowly bleeds their capital reserves dry over time until they fail. Metropolitan Capital simply ran out of time and capital before the rates could come down to save them. The asset size of $261 million makes this a relatively small failure by comparison. But in the world of banking, even a small crack can signal a breaking dam is coming soon. The FDIC estimates that the cost to the Deposit Insurance Fund will be $20 million for this. That is $19.7 million to be exact, according to their preliminary cost analysis released recently. This money comes from the fees paid by other banks to insure the system's deposits against such failures. It does not come directly from the taxpayer, but the cost is passed on eventually to the consumer. When insurance premiums go up for banks, they raise fees and rates for their customers to compensate. So in the end, the American consumer pays for every bank failure that happens globally in the system. The acquisition by First Independence Bank is an interesting development in this specific failure story worth noting here. First Independence is a minority depository institution based in Detroit that is expanding its footprint into new markets. They have stepped in to catch the falling knife and acquire the assets and deposits of the failed bank. This shows that there is still some appetite for consolidation in the banking sector today among stronger players. Stronger banks are willing to buy the assets of weaker banks if the price is right and subsidized. But the question remains, how many more weaker banks are out there waiting to fail in the shadows? The regulatory filing data suggests that the list of problem banks is growing quietly behind closed doors. The FDIC maintains a confidential list of banks that are at risk of imminent failure and seizure today. We do not get to see that list until the doors are locked and the assets are seized. But the failure of Metropolitan Capital suggests that the list is active and being worked by regulators now. The regulators are clearly taking a proactive approach to cleaning up the weaker institutions before panic spreads further. They are not waiting for a panic to set in before they close the doors on these banks. They are moving in on Friday nights and finishing the job before Monday morning opens to ensure stability. This is designed to maintain public confidence and prevent a run on the banks that could spiral out. But for the astute observer, it is a sign that the system is under stress and breaking down slowly. The timing of this failure in late January is significant for the broader financial outlook of the year. It sets a negative tone for the banking sector for the rest of the year 2026. Analysts will now be looking closely at the first quarter earnings of other regional banks for similar weakness. They will be looking for signs of the same capital impairment that killed Metropolitan Capital in this specific case. The specific mix of assets at Metropolitan likely included commercial real estate and business loans that went bad. These are the asset classes that are most vulnerable to the current high-rate environment and falling values. Commercial real estate values have plummeted in many sectors, leaving banks with underwater collateral on their loan books. If a bank lent $10 million on a building now worth $6 million, they are technically insolvent today. We do not yet have the full loan tape of Metropolitan to see the details of every bad loan. But the pattern fits the macro narrative that has been building for 2 years now in the economy. The Federal Reserve has kept rates high to fight inflation, and this is the cost of that policy. The cost is paid by the banks that cannot adapt quickly enough to the change in the environment. Metropolitan Capital was founded in 2005 and survived the great financial crisis of 2008. It navigated the housing crash and the pandemic only to fail in 2026 under this pressure. This speaks to the unique and punishing nature of this current interest rate cycle we are living through. It is a slow grind that wears down the defenses of even experienced bank management teams over time. The management of Metropolitan Capital was unable to raise fresh capital to plug the hole in their balance sheet. In this market, investors are wary of putting money into small, struggling regional banks with bad real estate exposure. Why would you buy equity in a dying bank when you can buy risk-free treasuries at 5%? This capital strike is what ultimately dooms these smaller institutions to the regulatory axe and closure by the state. Without access to new capital, they have no way to absorb the losses from loans that are defaulting. And so the regulators step in to protect the depositors and resolve the failed entity quickly and quietly. The closure of Metropolitan Capital is the first domino of 2026 to fall in this new cycle. It is unlikely to be the last as the year unfolds, and pressures mount on the remaining small banks. The lag effect of monetary policy acts with a delay of 18 to 20 months on the real economy. We are now deep into that window where the pain becomes real and visible to everyone on Main Street. The headlines will fade in a week, but the underlying trend is undeniable and dangerous for the unprepared. The consolidation of the American banking system is accelerating through failure and forced merger of these smaller entities. Main Street is losing its local lenders one by one to the history books and the big banks. The next phase of this crisis will likely involve larger institutions with similar problems hiding on their books. This creates a dangerous environment where only the largest banks are safe to operate and hold your money. The consolidation of financial power into fewer hands is a trend we must watch closely as investors today. As we analyze this failure, remember that your money is only as safe as the bank holding it. We must remain vigilant and informed about the health of the institutions holding our savings in this environment. The collapse of Metropolitan Capital is not an isolated incident, it is a symptom of a systemic disease. The diagnosis is clear and terrifying for anyone who understands the mechanics of the modern banking system today. It is called the lag effect of monetary policy, and it is currently crushing the regional banking sector. When the Federal Reserve raises interest rates, it takes 18 to 24 months to feel the impact. We are now standing exactly in the middle of that impact zone. The casualties are mounting quietly. The primary driver of this new wave of failures is the catastrophic decline in commercial real estate values. Metropolitan Capital, like thousands of other community banks, was heavily exposed to the commercial property market in Chicago. For decades, commercial real estate was considered a safe and boring asset class for conservative local lenders, but the post-pandemic world has fundamentally broken the economic model of office buildings and retail centers. Vacancy rates in major cities have remained stubbornly high, leaving landlords without the cash flow to pay mortgages. When a landlord cannot pay the mortgage, the bank is left holding a building that nobody wants to buy. The value of these collateral assets has fallen by 30 to 40% in many major metropolitan areas. This leaves the banks with a balance sheet full of loans that are worth far less than face value. Regulators call these zombie loans because the borrower is technically alive, but the underlying asset is dead. Banks have been playing a game of extend and pretend for the last 2 years to hide this. They have been renewing loans for struggling borrowers just to avoid realizing the loss on their quarterly reports. But you can only pretend for so long before the reality of the math forces a hard reset. The failure of Metropolitan Capital signals that the regulators are no longer willing to let banks pretend anymore. They are forcing institutions to mark these assets to their true market value, which wipes out their capital. This is why we saw the sudden seizure on a Friday afternoon without a prior public warning signal. The regulators looked at the books and saw that the emperor had no close and acted immediately. This aggressive regulatory stance suggests that there are many more closures coming in the months ahead of us. The Federal Reserve is trapped between fighting inflation and saving the banking system from a slow-motion collapse. They cannot cut rates to save the banks, because inflation is still lurking in the service sector data. So they are forced to keep rates high, which continues to put pressure on the bank balance sheets. This creates a slow bleed environment where the weakest institutions die off one by one over time. It is different from the fast panic of 2023 where massive banks failed in days. This is a slow-moving train wreck that allows the big banks to consolidate power at their leisure. The winners in this scenario are the giants like JP Morgan and Bank of America who have diverse assets. The losers are the small business owners who rely on local banks for their operating lines of credit. When a community bank fails, the local relationships and the local knowledge of the market die with it. The new owners from Detroit or New York do not care about the handshake deals of the past. They care about credit scores and automated underwriting models that reject many small business applications instantly today. This credit crunch is the secondary contagion that spreads from the bank failure to the real economy. As more banks fail or pull back on lending, the velocity of money in rural towns slows down. Small businesses cannot expand or hire, which leads to a slowdown in local employment and tax revenue. It is a deflationary spiral that begins in the bank boardroom and ends on Main Street storefronts. The $261 million of Metropolitan Capital is a drop in the ocean of debt. There's over $2.2 trillion of commercial real estate debt coming due by 2027. A significant portion of that debt is held by small and regional banks, just like Metropolitan Capital was. These banks simply do not have the capital reserves to absorb the losses if default rates spike higher. And default rates are spiking higher every single month, according to the latest data from the FDIC. The delinquency rate on commercial mortgage-backed securities has hit a 10-year high in the first quarter. This is the smoking gun that proves the distress is not contained to just a few badly managed banks. It is a systemic issue caused by the rapid repricing of the cost of capital in the economy. Borrowers who took out loans at 3% simply cannot survive in a world of 8% rates. The math does not work, and no amount of financial engineering can make it work in the long run. This is the reality that the market is trying to price in, but is struggling to fully comprehend. The stock prices of regional banks have been volatile because investors do not know who is holding the toxic assets. Transparency in the banking sector is notoriously poor until it is too late to save the equity holders. We only find out the truth when the FDIC press release hits the wire on a Friday evening. This opacity creates fear, and fear drives deposits away from smaller banks and into the perceived safety of giants. This deposit flight further weakens the small banks and accelerates their demise in a self-fulfilling prophecy loop. Metropolitan Capital likely suffered from some degree of deposit outflow before the regulators finally stepped in to close it. Smart money moves first and fast, leaving the smaller retail depositors to wonder what happened to their bank. While deposits are insured up to $250,000, anything above that is at serious risk. Business payroll accounts often exceed that limit and are vulnerable in a failure scenario like this one. We saw in 2023 that the government was willing to backstop uninsured deposits to stop contagion. But there is no guarantee that they will do that for every small bank that fails in the future. The moral hazard of bailing out every depositor is a political hot potato that Washington wants to avoid. So the official policy remains the insurance limit, and anything above that is a gamble on the bank. This reality forces every business owner to become a risk manager for their own cash management strategy today. You cannot blindly trust that your bank will be there on Monday morning just because it was there Friday. The due diligence required to navigate this banking environment is higher than it has been in decades. You need to look at the loan-to-deposit ratio and the commercial real estate exposure of your bank. If your local bank has 80% of its loan book in office buildings, run away fast. That is a concentration of risk that is akin to gambling your life savings on a single stock. Metropolitan Capital was a warning shot across the bow of the American middle class and small business owner. It tells us that the era of easy money and stable banking is officially over for this cycle. We are entering a period of creative destruction where the weak are culled from the herd relentlessly. This process is necessary for the long-term health of the economy, but it is painful in the short term. The liquidation of bad debt and malinvestment is a feature of capitalism, not a bug or an error. But when that liquidation happens inside the banking system, it threatens the plumbing of the entire economy daily. The Federal Reserve is watching this closely, and they know the risks better than anyone else in the room. They are trying to manage a controlled demolition of the zombie banks without bringing down the whole building. It is a delicate, high-wire act, and the winds of recession are blowing harder every single day now. The failure of Metropolitan Capital suggests that the wind is picking up speed and the wire is shaking. We must also consider the impact of this failure on the psychological state of the American consumer today. Confidence is the currency of banking, and when confidence erodes, the system becomes unstable and unpredictable. Every headline about a bank seizure chips away at that confidence little by little until it cracks. The cumulative effect of these small failures can be just as damaging as one large mega failure. It creates a pervasive sense of unease that changes behavior and reduces economic activity across the board. People save more and spend less when they are worried about the safety of their money in banks. This change in behavior is what turns a financial correction into a full-blown economic recession eventually. The data from the Metropolitan Capital failure gives us a glimpse into the future of this year. We can expect to see a steady drumbeat of these announcements as the year progresses and loans mature. The maturity wall of 2026 is real, and it is hitting the balance sheets right now. Banks that have kicked the can down the road are finding that they have run out of road. The refinancing gap is the difference between the loan amount and what the property is worth today. Borrowers need to bring millions of dollars of fresh cash to the table to refinance these loans. Most borrowers do not have that kind of cash lying around in this tight liquidity environment. So they hand the keys back to the bank, and the bank takes the loss on the asset. This transfer of wealth from the bank to the black hole of deflation is accelerating rapidly now. It is a wealth destruction event that is happening in slow motion before our very eyes today. The regulators know this, and they are staffing up their resolution teams for a busy year ahead. They are hiring contractors to manage the assets of failed banks and sell them back to the market. This is a growth industry in Washington right now, which tells you everything you need to know. The smart money is positioning itself to buy distressed assets from the FDIC at pennies on the dollar. This is the vulture phase of the cycle where fortunes are made by those with dry powder. But for the average American, this is a time of defense and preservation of what they have earned. The lessons of Metropolitan Capital are simple, but they must be heeded to survive this financial winter. Diversify your banking relationships and do not keep all your eggs in one basket or one bank. Understand the risks that are lurking on the balance sheets of the institutions you trust with your life. And never assume that the government will save you if you fall outside the lines of protection. The system is designed to protect the system, not the individual participant, in every single case. As we move deeper into this crisis, the noise will get louder and the confusion will increase. But if you follow the data and ignore the noise, you can navigate this storm safely. The most dangerous aspect of this banking failure is not the loss of capital, but the loss of liquidity. When banks like Metropolitan Capital fail, they stop lending money to the real economy immediately and permanently. This creates a vacuum in the credit markets that sucks the oxygen out of small businesses everywhere. We are already seeing this credit contraction show up in the latest Senior Loan Officer Opinion Survey data. Banks are tightening standards at the fastest pace since the great financial crisis of 2008. They are demanding higher credit scores and more collateral and personal guarantees for every single business loan. This means that perfectly healthy businesses are being denied access to the capital they need to grow. This is the transmission mechanism that turns a financial crisis into a painful recession for the working class. The failure of Metropolitan Capital is a clear signal that the credit window is slamming shut today. The ripple effects will be felt in the construction industry and the retail sector and manufacturing hubs. Projects that were planned for 2026 are being canceled because financing has suddenly evaporated overnight. This leads to layoffs in the trades and a slowdown in the purchase of raw materials. It is a negative feedback loop that accelerates with every new bank failure headline that hits the wire. The Federal Reserve is watching this credit crunch with extreme concern, but they are powerless to stop it. They can print money, but they cannot force a terrified bank manager to lend it to a business. This is the classic liquidity trap where monetary policy becomes ineffective at stimulating the real economy effectively. We are walking into this trap with our eyes wide open, but our hands tied by inflation. The only way out is for the bad debt to be purged from the system completely. This process of purging is what we witnessed on that Friday afternoon in Chicago with Metropolitan Capital. It is painful and ugly, but it is necessary to restore the health of the financial system. But the pain will not be distributed equally across the economy or across the population of the country. The wealthy and the connected have access to private credit markets and alternative sources of funding today. The small business owner on Main Street relies entirely on the local bank that is now failing. This widens the wealth gap and accelerates the consolidation of the American economy into fewer corporate hands. The tragedy of the community bank failure is the loss of the local economic sovereignty it provided. When decisions about capital allocation are moved from Main Street to Wall Street, the local community suffers. Wall Street does not care about the local bakery or the local machine shop in your town. They care about scale and efficiency and quarterly returns that can be extracted from the local economy. The failure of Metropolitan Capital is a victory for the centralization of financial power in this country. It brings us one step closer to a banking system dominated. This concentration of risk makes the entire system more fragile and susceptible to a catastrophic failure eventually. If one of the megabanks fails in the future, there will be no backstop big enough. That is why preserving a diverse ecosystem of smaller banks is actually a matter of national security. But the market forces unleashed by the Federal Reserve are destroying that diversity systematically and ruthlessly today. The regulatory response to this failure will likely be an increase in capital requirements for all banks. They will demand that banks hold more cash and less risky assets to prevent future failures. This sounds good on paper, but in reality it restricts lending even further and hurts the economy. If banks have to hold more capital, they have less money to lend to you and me. This is the paradox of regulation, where the cure often makes the disease of deflation much worse. We are seeing this play out in real time as regulators overcompensate for their past mistakes today. They were asleep at the wheel, while the banks loaded up on toxic commercial real estate debt. Now they are waking up in a panic and slamming on the brakes, which causes a crash. The crash of Metropolitan Capital is just the first fender bender in a massive pile up ahead. Investors need to look at the bond market to see where the real trouble is hiding next. The spread between corporate bonds and treasuries is widening, which indicates rising stress in the system. The bond market is smarter than the stock market, and it is screaming that danger is ahead. It is pricing in a wave of defaults that will make 2026 a historic year. The smart money is moving into short-term treasuries and gold to hide from the coming storm. They are getting out of regional bank stocks and getting out of commercial real estate investment trusts. This capital rotation is massive, and it is happening under the surface of the headline news daily. You do not hear about it on the evening news because it is technical and complex to explain. But the flow of funds does not lie, and it tells us that the smart money is scared. They are scared of what they see on the balance sheets of banks like Metropolitan Capital today. They see the leverage and the lack of liquidity and the exposure to falling asset prices clearly. And they are voting with their wallets by exiting the sector before the next shoe drops. For the individual investor, this is a time for extreme caution and conservative positioning of your assets. Do not chase yield in risky assets because the return is not worth the risk of ruin. Return of capital is more important than return on capital in a bear market environment like this. Keep your powder dry and wait for the dust to settle before making any major moves. The opportunities to buy distressed assets will come later when the panic reaches its peak intensity. We're not there yet because many people are still in denial about the severity of the crisis. They think Metropolitan Capital was a one-off event that can be contained by the FDIC. But history teaches us that there is never just one cockroach in the kitchen of finance. When you see one bank fail, you can be sure that there are 10 others hiding in the walls. The interconnected nature of the banking system ensures that contagion spreads faster than regulators can react. We live in a digital age where billions of dollars can move in a nanosecond globally. A bank run in 2026 does not look like lines of people around the block. It looks like millions of clicks on a smartphone app draining accounts in minutes without warning. Metropolitan Capital did not have a line of people outside, but it bled to death digitally. This speed of failure is the new reality that regulators are ill-equipped to handle effectively today. They are fighting a digital war with analog tools, and they are losing the battle consistently. This leaves the responsibility for safety squarely on the shoulders of the individual depositor and citizen. You must be your own central bank and your own risk manager in this dangerous new world. Hold some cash outside of the banking system for emergencies that might arise during a banking holiday. Consider assets that have no counterparty risk like physical gold or direct ownership of productive land. These are the hedges that have protected wealth during financial crises for thousands of years of history. The paper promises of bankers and politicians are losing their value with every new failure we see. Metropolitan Capital broke its promise to its shareholders and its community when it closed its doors forever. Do not let your financial future depend on a promise that can be broken by a regulator. Take control of your financial destiny by educating yourself and acting on the data we present. The collapse of this one small bank is a microcosm of the macro challenges facing America. We are a nation swimming in debt with an economy built on cheap money that is gone. The adjustment to this new reality is painful, but it is unavoidable for us as a nation. We will get through this crisis, but the landscape of the American economy will be changed forever. The dominance of the small independent bank is ending, and a new era of centralization is beginning. You have a front row seat to history as it unfolds in the charts and data. Thank you for watching this in-depth 3-part series on the first bank failure of 2026. We have dissected the failure of Metropolitan Capital from every angle to give you the truth. We covered the regulatory seizure, the toxic real estate assets, and the systemic risks that remain. This is a developing story, and we will continue to track the contagion as it spreads. If you found this analysis valuable, please share this video series with your friends and family. The algorithm suppresses this kind of hard financial truth, so we need your help to grow. Share it on social media and email it to your colleagues and talk about it today. The more people who are prepared for this crisis, the better off our country will be. Make sure you are subscribed to the channel so you never miss our future updates and investigations. We will be right here bringing you the latest data from the front lines of the economy. Leave a comment below with your thoughts on the future of the banking system in America. Do you think the big banks are too big to fail or too big to save? I will be reading your comments and engaging with the community in the discussion section below. Thank you for your time and for trusting us to bring you the real economic news. Until next time, keep your eyes on the data and your money safe and secure.